And first up, despite delivering a one-year US dollar return of a staggering 59.3%, the Sustainable Capital Nigeria Fund still believes the potential for further growth remains strong. And to support this assertion, the fund points to the fact that the Nigerian stock market is up only 6.8%. That is since the beginning of 2009 against the emerging market basket of 99.2%. Greg Barker from Sustainable Capital joins us from our Cape Town studio to make the case, and it sounds already, Greg, a very compelling one.
Yeah, and credit to the investors who seeded the fund. A good capital allocation decision on their part.
Greg, we just wanted to get into that. I mean, that is a huge number, 59.3% US dollar return against the all-share index, Nigerian Stock Exchange all-share index return of 57.1%. Just tell us what sectors drove that return, and especially if it was re-rating or is it being matched by earnings growth in the Nigerian market?
Yeah, it was from a sector perspective, the most compelling valuations when we started the fund were in commercial banks, and that's purely on fundamental financial factors and company quality. And we held over 50% of the portfolio in that sector, also with some infrastructure-related stocks like cement, and then also consumer stocks making up the balance. And that has driven the performance over the time period. I think what you're seeing in terms of investors in Africa, you've got a very broad spectrum from those who are only entering Africa for the first time, and perhaps a Pan-Africa fund is most appropriate for those investors, and others like the investors who've put the anchor capital into this fund have already been investing in Africa for many years and are taking a specific asset allocation decision within that geography.
What is the perceived risk, Greg, what is the perceived risk when it comes in investing in Nigerian equity?
Well, I think you need to define risk firstly in terms of coming from two things. Firstly, it comes from not knowing what you're doing, so not knowing enough about the companies that you're investing in. And the only way you can mitigate that is through detailed research at a company level in the country and doing, kicking the tires, checking what's going on with each company from a pure bottom-up perspective. And the other risk is the price that you pay for the security. And I think you alluded to that in your introduction. And what a lot of people miss is, the base that these stocks is coming off was completely distressed. So despite the fact that the fund has done a 59% return in US dollars net of trading costs, you still, in terms of underlying valuations, on a stock-specific basis, got very compelling entry points.
So at this point, Greg, I just wanted to understand, just coming back to that question around how valued the Nigerian market is overall. What's the sort of long-term average price-earnings ratio, and where is the market at the moment?
Well, I can tell you on a portfolio-weighted basis for our fund, and there you're not talking about illiquid stocks, because the portfolio-weighted average market cap is $5 billion US. So you're talking about high-quality blue-chip liquid companies. And there, the weighted average for the portfolio is a price-to-earnings ratio of 15 on a historic basis. Now, that's obviously looking back to earnings that were reported for 2012. What's interesting is how quickly that price-to-earnings ratio compresses, because we're already halfway through 2013, and looking forward to next year, that ratio compresses to below 10 on a price-to-earnings ratio basis, because you've got underlying earnings growth on the companies of 34% on a portfolio weighted basis, year-on-year earnings growth. And just coming back to your earlier question on re-rating, we have seen a re-rating off a very low base of the market, and now what we're seeing is earnings growth coming through for the companies. For example, looking purely on dividend yields, we've got a historical dividend yield on that fund of 4%. Again, looking forward to next year, that expands to 5.8% US dollar dividend yield. So, from a pure downside risk perspective, that's quite compelling, because if those share prices had to come off, you effectively have got equities with very good long-term growth prospects, which are almost trading at the yield of a bond.
Greg, let's talk about some of the star performers in that portfolio. Particularly now, let's name a couple of the companies that you think are good buys going forward as well.
Yeah, if we look at some of the, looking backwards at the attribution of the fund, for example, a company like Access Bank, where we've had a total return of over 80% over that period. And yet even today that company is trading on a discount to its book value. Yet, it's looking forward going to a return on equity of 23-24%. And, if you buy that stock today, you're getting it on a dividend yield of 8%. So even some of the stocks which have performed very well over the period since inception are still core holdings within the fund. In other areas where, we've seen outperformance where stock has moved past its, what we think is justified from the fundamentals and the quality of the company, there we would have exited.
Greg, we've obviously got the, when we look at the all-share index in South Africa, it's obviously gives you some indication of what's happening in the country, but the all-share index in Nigeria and the Nigerian market, as I understand it, is very concentrated around the Nigerian economy itself. So when you're buying the companies in that market, very little of those earnings are coming from outside Nigeria. Is that an accurate assessment?
Yeah, if you looked at the look-through, on a look-through basis, for example, in the Sustainable Capital Nigeria Fund, and that's looking purely at the revenue, the operating profit, and the assets of the companies that we invest in, you're getting close to 100% pure underlying exposure to Nigeria, rather than Nigeria-listed stocks which are, have their true economic footprint in other countries.
What about the current turmoil we're seeing coming out of that territory? Do you take cognizance of that as equity investors in Nigeria?
Absolutely. I mean, you have to price socio-political risk into your investment decision-making process, into your valuations, into your portfolio construction. But counterintuitively, short-term perceptions of political risk are often the best opportunities for long-term investors. And you can see that from looking at a country like Nigeria over the last year. The Boko Haram risk in the north of Nigeria is probably one of the most overblown risks from a pure investment perspective. If you look at the impact that it has on the companies in our portfolio, it's almost immaterial. Yet it gets, trumped up in news story because it makes a good story.
So that's obviously where you add value, or you believe you add value, is looking past just some of the sentiment that flies around in headlines. I just wanted to see, you've just celebrated the first anniversary of this fund. It's obviously a heck of a number to put on the track record, is that you're up 59%. Has there been a great indication to receive more capital for the fund and the market as a whole?
Yeah, we're seeing quite strong interest from, as I mentioned earlier, the more progressive, sophisticated investors who are already making decisions to allocate their capital within Africa. And I think just, what value we're trying to add is not just giving a very efficient exposure to the Nigerian listed equity market, which, if you look at our total expense ratio, is industry leading. And also on the fee is flat, so the investor gets all of the upside. But also doing that at a materially lower level of risk than the market, and that's key in any African jurisdiction, because you're going to get strong underlying returns. And for our investors, it's not so much about what the return was this year. We want them to be in a good position 5 years from now looking back. 1 year performance is still very early days and short term. So it's a case of building that track record to a much longer time frame.
Greg,
and you do that by managing the downside risk.
Let's talk now. This is a country-specific fund. It's done very well for you, and obviously the market is affair with that Nigerian consumer growth story as well as other stories in that territory. But what about a Ghana-focused fund? Can we expect similar country funds to emerge from you?
This fund was purely driven by a client request and has subsequently enjoyed participation from other investors who also wanted to get direct Nigeria exposure. I think a Ghana country fund based on today's market would be completely infeasible, simply because the starting point for our investment process is always liquidity, and we don't see sufficient underlying liquidity in the Ghana Stock Exchange that we could run a fund in the same way that we've done, for example, in Nigeria, or our Africa Consumer Fund, which is a Pan-Africa consumer-led fund. There's simply not sufficient underlying liquidity in that market.
Greg, just a question around South Africans' attitude to investing on the continent. Has it been pretty easy? You talked about those very wise investors, progressive investors, I think was the word you used. Are South Africans amongst those, or are you still finding the most interest coming from places like Europe and the States?
I think South Africa has been one of the slowest countries to move, ironically, because Africa's on our back doorstep. We make the assumption that we know what's going on there. But for example, if you look at the investor base of the Nigeria Fund, it's mainly institutional investors from the UK, from Scandinavia, from Europe, and we've started to see interest from the US as well now.